Hi everyone, and welcome to this presentation where I'm going to show you how you can potentially grow your retirement account 7 times bigger, 7 times faster, and with 7 times less risk through the super portfolio rotation signals, which have a 96.25% win rate, which I will talk about here more in a minute. The super portfolio rotation was released in June 2023, and since that time it has closed out 80 trades with 77 winners for a 96.25% win rate. And those are actual fills, not hypothetical. And the 1-year return has been approximately 15.7%. And through these signals, I'm going to show you how to pocket as much as $1.9 million for every $10,000 in your retirement account, college savings, trust fund, or any other account where you want to achieve exponential growth over time while dramatically lowering your overall risk exposure compared to conventional investment approaches. I'm also going to reveal 3 secrets behind the extraordinary success of the super portfolio strategy. And the great news about all of this is that we've done all the work for you. If you want to take advantage of the alerts, all you have to do is subscribe. There is nothing to learn. There's no software to set up. It requires very little time, just a few minutes each week, and very little capital to take advantage of these signals. And you too can potentially grow your retirement account 7 times bigger, 7 times faster, and with 7 times less risk through these very straightforward signals from the super portfolio rotation strategy. Now, most investors would be thrilled with a 10% annual return every year. 10% compounded over 20 years is equal to turning a $10,000 account into over $67,000 over that 20-year period. But that is a far cry from turning $10,000 into $1.9 million. But it's not as far away as many believe. The power of compounding returns is actually far greater than what most investors understand. And because of this, little attention is paid to investment strategies that can add another 2% or 5% or even 10% to their annual returns, because to increase your overall return from turning $10,000 into $67,000 to turning that same $10,000 into $1.9 million seems like a complete impossibility. So which would you rather have? $10,000 into $67,000 or $10,000 into $1.9 million? Obviously, everyone here is going to want the $10,000 into $1.9 million strategy, but the problem is that most investors don't believe that conventional type investments will get you anywhere close to that. And so what they do is they turn to high-risk home run type trades, thinking this is the only way to really achieve wealth. They take big risks, thinking that they have to do that in order to achieve wealth. So for example, they invest in expensive and extremely risky penny stock trading services, or they take long shot investments in pharmaceutical companies. And in both of those, most of the time they end up taking a bath. But the good news is that you don't have to take huge risks in sketchy stocks to potentially realize $1.9 million for every $10,000 you have invested. So then that brings in the question, what does it take to pocket $1.9 million for every $10,000? What kind of returns are you going to have to generate? Most of you think that they're going to be unrealistic, but what I'm about to show you is very simple. It's proven, yet it's absolutely brilliant. It is simple, it is proven, yet it is absolutely brilliant. So let's just go through this for just a minute. 10% annually compounds a $10,000 account into $67,000 in 20 years, right? What about 12%? Well, if you can increase your annual return from 10% to 12%, then that compounds that same $10,000 into over $96,000 in 20 years. In other words, a 2% increase in the overall annual return will actually increase your overall return after 20 years by 30%. So that's not too bad as far as the compounding is concerned. But let's keep going for a little bit. What's 15% annually do? Well, 15% annually compounds 10,000 into over 163,000. Now, a 5% annual increase, increases your overall return by 144%. So this is nothing to sneeze at. You're talking about over $100,000 more if you can just increase your 10% annual return into 15% annual return. And I'm going to pull out my little drawy thing here so that doesn't happen again. But 10% to 15%, and you're increasing your overall return at the end of the 20 years by 144%. So it's kind of like taking aim, right, with a gun, and you take aim at the target, and if you're off just a little bit, by the time the target is reached, it's actually off quite a bit. Well, this is the same thing. If you can increase just a little bit in your overall annual returns, that really adds up by the time you get to the end of the equation. So on a 20% annual return, you're talking about compounding 10,000 into over $383,000 in 20 years. So this increases, if you can double your annual return from 10 to 20, you're talking about a total return after 20 years increased by 472%. So instead of 67,000, you'll have 383,000. So it is really important to invest in such a way that it's going to increase your overall annual return. And maybe it increases a little bit, but if you can implement certain steps, if you will, that will increase your overall annualized return, that will pay off huge in the long run. And of course, what we're going to try and do is we're going to try and do that without taking any additional risks over the normal investment, conventional investment strategies. Okay, now just a couple more, one more, 30%. That's what you have to get to. 30% annually compounds 10,000 and over 1.9 million in 20 years. And by this time, a lot of you are saying, well, 20% is getting a little bit out there. 30%, no one achieves 30% annual returns over a 20-year period. You have the market crashing. You just don't have, stocks are not going to go up 30% every year for the next 30, 20 years. And that's absolutely correct. But if I can show you a few little tricks in how you can put yourself in a position to actually achieve this, even if stocks crash, even if stocks don't see these big gains year in and year out, would it be something that you would be interested in? Probably so. So I would strongly encourage you to watch this video and see what things we can do to put ourselves in a position to achieve 30% annual returns, average, obviously, and increase our overall potential return from, instead of a 10% giving us 10,000 into 67,000, we can potentially turn 10,000 into 1.9 million. That's 2,735% increase in your overall return after 20 years. So if you learn nothing else, so let's say you don't get to 30%, that's fine. But what you will learn is that every percentage point matters. Even if you don't get to 30%, every percentage point matters. It matters quite a bit in the long run, especially when we're dealing with compounding. And I'm even going to show you how we don't have to achieve a 30% annual return to get the same benefit. And you're like, what are you talking about? Well, I'm going to get to that as we go through this strategy. Like I said, it is very simple, it is proven, and it is brilliant. So our goal ultimately is to achieve an average of 30% annually. And if we don't meet that goal, every percentage point matters. So even if we don't, the steps that we can take to improve our returns are going to matter in the long run. But that's the goal because 30% annually compounds 10,000 into 1.9 million. It's a very unrealistic goal with the buy and hold, right? Stocks are not going to move up 30% annually for the next 20 years. They're just not going to. And so it's not only unrealistic with the buy and hold strategy, it's practically impossible. So we have to do something other than the buy and hold in order to put ourselves in that position. And that brings me to the first secret of what we're going to do. And I want you to see something here before we get to that. Since 2000, the total compounded return on a $10,000 account in SPY, which is the S&P 500, only it's the ETF, but a $10,000 account grew that account to $57,000 over the last 24 years. That's only 7.41%. That is not that great, right? An annual rate of return of at 7.41%. You buy and hold, you stick with it, and that's what it is. That includes the dips, that includes the crashes, that includes everything. So it's a total increase of 474%. It's not bad, but this is not anywhere close to what we want to achieve. We have to do better than this. We have to do better than this if we want to have any shot at reaching our goal. And so it begins with a little bit of analysis. And I'm going to give you the year 2000 as an example because that's the year that I really started to look into how the returns are generated within the stock market. So in 2000, major stock indexes were up about 20%. However, in the S&P 500, the entirety of that 20% move could be attributed to just 25 different stocks. In other words, what that means is if you didn't have those 25 stocks in your portfolio, you had some other combination of stocks within the S&P 500, then you likely didn't come anywhere close to generating the 20% returns that year, because the majority of the returns can be all attributed to just 25 different stocks. The top 25 performing stocks would have produced the 20% return. Now, in most years, it's very similar. The majority of the returns of an index are attributed to a small group of stocks. And if you don't have that group of stocks, you're not going to even equal what the S&P index returned that year. And again, remember, every percentage point matters. So the first secret to achieving above average returns is to have a group of rock solid, proven stocks that have consistently outperformed the S&P 500 year in and year out. Now, I'm going to tell you right now that does not mean that these stocks are going to continue outperforming the S&P, but you have a proven track record, a long-term proven track record of certain stocks that have consistently outperformed the S&P 500 over the past 24 years, and that's going to give you a higher probability that you're going to have a solid group of stocks that will continue to do that. Now, it's not a guarantee, but that's the first secret. So rather than try and hit the long shot home run in some pharmaceutical company or a risky crypto trade, we're going to invest in math. That's what we're going to invest in. And we will invest in rock solid, proven stocks and let the compounding create our wealth. But the first secret is to create that first group of stocks. And so what I'm going to show you is I'm going to show you a group of just 10 stocks that are from a pool of over 150 stocks that we have painstakingly researched and settled on as our super portfolio group of stocks. So the first secret and the foundation of what we're doing is we're going to limit the stocks that we invest in into a very high performing, very consistent performing group of stocks. Solid, proven, long-term stocks will make up what we will invest in the super portfolio signals. And so this is the foundation from which we will build on to target the achieving the 30% annual returns. Again, buy and hold in even these very unique stocks, proven stocks, is not going to get us where we need to go. But we have to start somewhere. And so that's where we're going to start. That gives us the foundation from which we can build on. So I'm going to reveal what these I'm going to reveal 10 stocks that are at the bottom of the stocks in our group of 150 total stocks. You're going to recognize some of them, and some of them you may not. Okay? So this is the first one. Probably not going to recognize this one. But this is ATR. ATR's in our 150 plus group of stocks. And if you would have invested $10,000 into ATR on January 1st, 2000, today that investment would be worth $162,325. So clearly that outperforms the S&P 500. That's an annual rate of return of 12.06%. So again, nowhere close to our 30%, but we're not going to be buying and holding this. But it's going to give us a solid start. So this is one of the bottom stocks in the group, ATR. Another one is in EQT. Again, probably not real familiar with this stock, but a $10,000 investment into EQT would have turned $10,000 into $132,000. Again, this is about an 11.51% annual return. Better than the S&P, not quite where we need to be, but again, just an example. Here's one, PepsiCo. PepsiCo, not that great at 9.78%, but still outperforming the S&P year over year. And the consistency within Pepsi is really kind of what put Pepsi over the edge. And it's not just about overachieving the S&P or beating the S&P. It's about the consistency with which it does so as well. And PepsiCo is very, very consistent in doing that. Here's another very good stock. It is Royal Bank of Canada. If you would have invested $10,000 on January 1st, that would have turned $10,000 into $216,000, or an annual rate of 13.38. Now we're getting up to some bigger numbers. And again, these are within the bottom part of are 150 stocks. They're not even in the top part. Here's UHT, Universal Health Realty Income, and 10,000 would have turned into 142,000. Here is Abbott Laboratories, ABT. 10,000 would have turned into 113,000. Again, about 10.78% annual return. Here's Hormel Foods. Everybody probably knows Hormel Foods. I actually like this stock for a couple of reasons. Hormel Foods, HRL, turned $10,000 into $115,000 since the year 2000. And that's an annual average rate of return of about 10.88%. Here's actually one of my favorite as far as consistency and longevity. This has a really great return since the year 2000. If you would have invested $10,000, you would have turned that $10,000 into $253,000 over the last 24 years, and that's at an average annual return of 14.12%. But if you look at SO goes back into the early 80s and has been consistent in producing these kind of returns since the early 80s. So you want to talk about a long haul quality stock, SO is it. Now, as quality as it still doesn't, reach the 30%. Very few of these on a buy and hold will, by the way. But again, this is just our starting point. Here's another one, FISV. And this stock turned 10,000 into 232,000 over the last 24 years. That's a 13.71% annualized return. Couple more. I'm just giving you these. Oh, I'm sorry. That was it. So that was number 10. And I'm going to show you a couple bigger ones. So here's one of the best performing. And this one turned 10,000 into 12 million at a average growth rate of 35% annually. So here's one of these where you can see, 10,000, it's not 1.9 million. 10,000 actually turned into 12 million over the last 24 years at a whopping 35.08 annual rate of return. Very, very high performing stock. This one, if you would have invested a little bit more, just to kind of give you an idea. So let's say you're starting with more than 10,000. This is a $25,000 investment example. At 35%, you're looking at 31 million. So this $10,000, most retirement accounts have more than $10,000 in them. Most college funds eventually have more than 10,000. If you have any kind of retirement account, you're constantly putting money into it, and you're trying to get that as big as possible so that your average annual returns increase. Well, 25,000 at a 35% annual rate of return, you're looking at 31 million. So this is nothing to sneeze at. Again, every percentage point matters. Also, if you have more, 10,000 and 1.9 million is just the beginning. So you're looking at $100,000 starting would turn that same 1.9 million into 19 million. Right? So if you have more, you're talking about big numbers. And this is one stock that would have done it over the last 24 years. Now, this stock, I can almost guarantee you, is not going to continue performing in this manner. And so you can't count. You don't want to go into this stock and say, well, this is turned into 25,000, turned into 31 million in 20 years. I'm just going to put it all in that stock. Well, it's not going to happen that way. This stock was an outlier, and it's not going to reproduce itself. All right, so just kind of put that out of your mind. Nevertheless, here's here's a couple more that are in the upper echelon of our 150. So, for example, here's Starbucks. I invested 10,000 into Starbucks in 2000, and you're talking about 401,000. Annual growth rate of 16.85%. I don't think that is sustainable over the next 20 years either, but it does make the top 150 quality stocks that we are invested in. Here's a group of more. I'm not revealing what these are in this video, but just take a look here. 10,000 turns into 558,000. That's 18%. Here's 19%. Here's 21%. So you have a lot here that have produced almost 20% returns with the buy and hold. 26%, this turns 10,000 into 1.3 million with the buy and hold. Right, here's $500,000 at 19%, 17%, 20%, 18%, 19%. So you can see here we have a lot in that range. Now, whether they'll continue to reproduce that or not, obviously we don't know, but that's one of the reasons why you diversify. That's why we have such a large group of quality stocks. And again, we're not buying and holding. So you're not in all 150 plus stocks at any given time. And I'll get to that more in a minute. But nevertheless, $25,000, if you have more than $10,000 to invest, if you invest $25,000 and you're able to achieve a 25% annual return, that $25,000 turns into 1.1 million in 17 years. Right, so you can get there with less than the 30% returns If you have a little bit more that you're starting with, and obviously the more you have that you're starting with, the better off you're going to be, but every percentage point matters. And most of these stocks that made our group are not obvious. And in fact, you wouldn't recognize most of them. You probably only recognized a few of the stocks that I've already revealed to you that are in this group. Here's a few popular stocks that didn't make the cut. Walmart did not make the cut because it underperformed the S&P. Bank of America underperformed the S&P. Tesla did not make the cut because it's only been around since 2010, even though it has dramatically outperformed the S&P. And it might continue to do so, but the risk is just too much there. It's not proven enough. So we did not include that into our group. Here's another one, Verizon. It's been around long enough, but it underperformed the S&P. And in addition to that, its growth potential really isn't all that big because they're not offering anything new into the industry, right? They're not like offering any kind of new technology. They've got a lot of competition. The only thing they can do is try and get a bigger piece of the market share. That's really all they can do. And so they're not going, the probability of a company like this continuing to grow is just really not that high. So they didn't make the cut. Ford Motor Company, kind of in the same boat. What can Ford Motor Company do to get a bigger part of the market share? What are they going to do to add value to their stock over the next 20 years that all the other car companies aren't doing, right? So not really expected to outperform the S&P as a whole, and didn't make the cut. So kind of get an idea, we need several factors several criteria that these stocks need to meet in order for us to include them. And so we've already done that work, and we've done the research, and we have created this group of steps, this group of stocks. So our first step is to give you a solid probability of achieving at least extraordinary returns, even with just the buy and hold. That can then compound into millions. And that is how we start this process. It is to start with a rock solid proven group of stocks to invest in. Okay? All right, so that's the first secret. This is the foundation of the super portfolio rotation, and it is built on solid ground. Now, what I want you to notice here is the 1 year performance of the bottom 10 stocks. Okay, the 1 year performance. In other words, we created this over a year ago, and we are making some changes, some slight changes to this group of stocks based on new information, et cetera, et cetera. It doesn't change a whole lot year over year, but there are some changes. But what I want you to notice is I want you to notice the bottom 10 stocks that I revealed to you already and what they did since we released this program, June 1st of 2023. And you'll notice here is ATR. Average return is 12.06, but ATR over the last year is at 27.67%. So it outperformed even its average, and we will have those types of stocks that do that. Here's EQT, 11.5 is the average, and it returned 12.7 over the last year. Here's one, PepsiCo, averaged 9.78, but it has underperformed. It's actually down since the last year. So we have one that is down a bit, and we have one that has significantly overachieved. And so it kind of all averages out, and that's what we're actually going for. Here's Royal Bank of Canada, 13.38%, but over the last year, it's actually up 20%. Here is UHT. It was up an average of almost 12%, and it's actually down this year a little bit. And so, again, it kind of just averages out. Here's a lower performing stock, but it's still up. It's ABT, and it's up only 2.9%. 9.48% compared to an average of 10%. And here's our dog of the year. And I actually like this stock right now. Nevertheless, it's HRL averaging 10.8%. Since June of last year, it's actually down 16%. So you can see the stocks, it doesn't mean that they're going to be up every year. And in fact, about a third of the stocks in our portfolio are actually negative in any given year. And that's been the way it has been since the beginning of our analysis. So you go back to 2000, and every year about a third, actually a little less than that, about a little less than a third of the stocks finish the year down on average. So it's not like every stock that we get into is going to move up. That's not the idea. Again, here is another one. Southern Company averaged 14%. It was actually up 16%. I really like Southern Company. Here is FISV. Its average is up only 13%, but it was up 28% during the market during the last year. So you get the idea. It's going to average out. And if you take a look at that, the average 24-year average of the bottom 10 stocks were up 11%, and the 1-year performance of these stocks is also up 11%. So I wanted to point that out because that's very important for you to understand how this all works. But that's going to lead us to the next step, or the next secret. Secret number 2 is timing. It is timing. Now, there are a lot of different timing approaches out there. But what I want to show you is a very simple timing approach. I have 4 criteria that the stock needs to meet. And that's going to help us with the timing. But what I want you to see is I want you to see one of the stocks that are in our group. And that is Helen of Troy Limited, HELE. Most of you probably do not know about this stock. Nevertheless, a $10,000 investment in HELE would have turned into $137,000 over the last 24 years since 2000, an average annualized return of 11.32%. Okay, so it's down there in the bottom part of the stocks. And if you would have invested $10,000 into HELE on June 1st, 2023, you would actually be down ever so slightly. So it's one of the stocks that has underperformed over the last 12 months, and you would have been down. But I want to show you an example of what the timing can do. And here is the part of the track record. Again, all of these are actual trades, 96.25% winners. About a little less than a third of the stocks are down every year, but our closed trade percentage over the last year has been 96%. Now, I do not expect that to continue. I think we've overachieved as far as that is concerned. But I want you to notice HELE. We've taken 2 trades in HELE. The first one was on November the 13th of 2023, and then we exited on 12/14. So we didn't hold on very long, about a month. And we ended up making a 24% return on that trade alone when HELE has been down for the year. All right, so that's one example. The other example we took on May 1st of 2024, and we exited just 2 weeks later. And we exited at a 15% return. So annualized, that's at 476%. The first trade was at 284%. Okay? These are the only 2 trades that we have taken in HELE since inception of the SPR signals on June 1st of 2023. And this is in a stock that has not done well, and yet we have garnered, based on the investment, a total return of 40% NHELE. And that's because of the timing of these stocks. We don't want to buy and hold because the buy and hold is still not going to get us where we need. So we want to time it a little bit. And when you're in a scenario where you have a super portfolio rotation track record of a stock that is actually down over the last 12 months, you take 2 trades and you're up 41%, that tells you what is potentially available in these stocks if you add a little bit of timing into the scenario. So this is what I wanted to show you as an example, as the first example. And you can see here are the closed out losses. We had a closed out loss of 1.67%, and another one at 9.82%, and then one at 12%. And you'll notice there are quite a few that are larger than our largest loss. Here's a 17% trade. Here's 12%, 23, 32, 12 again, 14. So you can see here we have a wide range of returns and 3 losses. Those are our largest 3. So here's the rest of the group, and you can see here again, a lot of pretty decent size returns. And look at the annualized returns, because we're not in these for a long time most of the time. This is entering on October 31st and exiting 2 weeks later. And there are several of those in here. And then there's some longer ones. Here's entering on 11/20, and we don't exit for another, basically 6 months. And the return on that's still 14%, but it's a smaller annualized return at 30.5%. Right, so this is what I want to point your attention to now. Annualized returns. What do we need to achieve in order to turn 10,000 into 1.9 million? We need an annualized return of 30%, right? But these annualized returns, you'll notice almost every one of them is more than 30% annualized. Here's one that's only 15%. Let's see if we can find, here's one that's only 2% annualized return. We barely made anything on this. We basically broke even, and we were in that trade for about 5 months, right? And so we annualized, that's only a 2.32% annualized return. So a little bit smaller. But notice here's 29%, here's 24%, here's 29%, so most of these, we only have a handful, 5 in this group that have an annualized return of less than 30%, right? So the timing here creates a scenario where we can increase our annualized returns with these individual trades. Now, I've been trading since 1987, and I've seen, tested, and traded everything under the sun. And suffice it to say that out of all my research, I've narrowed down to what I believe to be 4 basic conditions that need to exist in order for you to have a higher probability of realizing a decent annualized return with any given stock. And that doesn't matter which stock you're talking about, whether they're in our foundational group of stocks or outside of the group of stocks. If you have these 4 basic conditions, and these are all present at the same time, I believe these give you the highest probability of yielding the most efficient return in any given stock. Right? So if these 4 basic conditions do not exist or are not present, then I am not going to buy the stock. When they become, all 4 need to become present, then I buy the stock. So in short, I take the stocks that are already in the super portfolio, and I look for these 4 conditions to exist. And I'm not going to reveal these 4 conditions because it is the proprietary piece of this puzzle, if you will. And again, we've done all the work for you. We provide the signals, but I'm just explaining to you the logic behind of it. So if all 4 of these exist, I buy. And if one of them ceases to exist, then I look to exit. Now, I don't necessarily exit immediately. I look for a favorable exit. And so on some of these, for example, When the fourth condition, or all four conditions, it dropped from four conditions present to only three positions, I didn't immediately exit this trade. I put in an exit order for a favorable exit and waited for that favorable exit. Now, if it drops down to only two conditions, that's another story. And so I look to buy if all four exist, or when all four exists. And then when one of the four ceases to exist within that stock, then I look to begin an exit. So what do these four conditions do? That's really the question. What do these four conditions do? Well, here is ATR as an example. 10,000 turns into $138,000 for an average annual return of 11.71. That's on the buy and hold. You're never going to get out. You're always going to just stay in. And there's no timing involved in that whatsoever. Well, here is ATR. Again, one trade on 11/28, exited on 3/7 for a 15% annual return, 56.71% annualized. Right? That's the only trade in ATR that we have taken, because that's the only time that all four conditions existed. All right, so out of that, I want to show you the historical track record of ATR when all four conditions exist. 87% winners, an average annualized return of 34%. So 87% winners, an average annualized return of 34%. And so that increases automatically what it's doing. The average annualized return of 34%, if this is the only stock that you traded, and when all four conditions were green, and you were long, and when all four conditions were not green, or one of them, I'll call it blue, right? When one of the conditions turns blue, then you look to exit. Well, that produces 87% winners, or has produced 87% winners. So here's one of the other things I want you to notice. We only had market exposure 25% of the time. So again, if you take this one single stock and you apply the timing, and you're able to achieve an annualized annual return of 34%, you're going to turn 10,000 into more than 1.9 million with this stock and this timing mechanism, or you would have, let's put it that way, because obviously it doesn't have to repeat itself. Nevertheless, it would have done so in only 25% of the time. So this is the trade length, and it is trading days. It is not calendar days. And so that comes out to about 25% of the time. So in other words, if you're only in ATR 25% of the time, and you're flat 75% of the rest of the time, you're not being exposed to market conditions, market crashes, etc., etc. So you could literally take one stock and apply this approach and give yourself a really solid opportunity to achieve the 34% return, or the 30% annualized return that we're looking for, and do so with a fraction of the market exposure. Okay? I can't tell you how important that is. Now, that is one piece of the pie. I'll get to this the third secret here in a second. But here's a sample group of SPR strategy stocks, hypothetical, over the last 20 years. The winning percentage of these, you'll notice, is almost always above 70%. In other words, this is when the four conditions exist. And the average annualized return, some of them are not, hugely impressive, but some of them are, quite a bit bigger. So you have a few lower ones and you have a few bigger ones, and it's going to average out. And it all averages out to about 30%. And this is just a random group of stocks within the super portfolio rotation. So this is the benchmark. The annualized returns is orange. And so you can see it's going to average about that. If you add them all up, you're looking at about achieving that average with this group. And you're looking at win rates all above 70% with this. So that's pretty decent. So, when stocks move, obviously annualized returns increase substantially. Stocks have to move. If they move, the annualized returns increase. The average annualized return on all closed trades since we released this on June 1st of 2023 is 73% annualized returns. These are actual trades, not hypothetical. So we are exceeding the average annualized return with the closed trades, and then we have to average in any obviously open positions and the amount of time and the amount of investment that we have in place. Okay, so these are the secrets. These are the first two. Number one, start with a solid foundation group of stocks. Number two, add a proven high efficiency timing method. And so those are the first two. Number three, and this is a big one, the third secret to achieving above average returns that can compound into millions is rotation stacking. Rotation stacking. All right. Now, how do you achieve a 30% annual return without achieving a 30% annual return? Remember, I said I was going to show you how you can potentially achieve a 30% annual return without achieving a 30% annual return. And you're like, what in the world does that mean? Well, I'm going to go back to this. Every percentage point matters. Every percentage point matters. Okay? And here is what rotational stacking is all about. And this is just for illustrative purposes only. Okay? Number one, you're going to pick a stock and you're going to hold it for 3 months. And let's say you pick a stock, all four conditions are green, you hold it for 3 months and you gain 10%. Well, you're in and you're out, and you now have a 40% annualized return because you only took 3 months and you're in that stock. You gained 10% net gain and you're out. So come April, the stock moved, right? What's the chance it's going to continue moving another 10% every quarter? Probably not that good. Right? It might, but you're out and you've got your 10%. Now you're going to look for another stock that is prime and ready to move 10%. You hold on to it for 3 months. Let's say you gain 10%. You've now averaged 40% on that trade as well, as far as an annualized return is concerned. You do the same thing in July. You do the same thing in October. By the end of December, if you are able to achieve a 10% return in a 3-month period with 4 different stocks, you have now gained 40% annualized return, right? If you add it up, 40% annualized return. But there's one thing that you're not accounting for in this. You turn 10,000 into 14,000. If you do that every year, you're going to have way more than 1.9 million. This is why the buy and hold doesn't work, because when a stock makes a move, it doesn't continue making that move. So what you want to do is you want to put yourself in a position when it's about to make the move, if possible, if you can do that. And so if you can do that and you stack and you rotate, guess what? Based on rotation stacking, you are compounding intra-year. So in other words, if I have $10,000 and I put it in one stock and I make 10%, my 10,000 turns into 11,000. Well, in April, I pick a stock. I pick another stock and I put all 11,000 in that stock, not 10,000. So 10% on 11,000 instead of 10,000 is $1,100 instead of $1,000. So now I do that again. I put the whole thing in July, I put the whole thing in October, and now I am involved in intra-year compounding. Now, remember what I said. Every percentage point matters. And in this example, at the end of the year, instead of 10,000 growing into 14,000, 10,000 grows into $14,641. So you actually increase it by about 6.4%. You go from 40% annualized return into now 46.1% annualized return. And every percentage point matters. So you've increased your average return by $641 or 6.4%. And if you do that year in and year out, you're talking about a massive increase in your overall net profit. Now, obviously, it's not going to work out this way, but by quarterly compounding at 5% per quarter, right, compared to a 20% annually compounded, 10,000 turns into 383,000 after 20 years. Okay, that's with not profit stacking, not rotation stacking. So if you are able to rotation stack it and compound quarterly, you would not compound at 20% annually. You compound at 5% quarterly, and you're looking at 495,000 instead of 383. You're talking about a $112,000 difference just by switching from being able to compound it annually to compounding that same return quarterly. It's a significant difference. That's a 29% overall increase in your total return. So even if you don't make 30% annual return, you can still rotation stack it. And that's still going to create the quarterly compounding or some type of that rotation stacking where you're compounding on a much more efficient basis. So like I said, we're going to invest in math. All right, and this is what this does. You invest in math. 20% on a $50,000 investment turns into $1.9 million after 20 years. Okay, that's with that's a buy and hold type deal. If you can buy and hold and 20% annually, that's what that turns into. However, if you turn that same 20% compounding into 5% per quarter compounding, instead of $1.9 million, it's $2.4 million. That's an additional $500,000. Very, very important. So you create, again, an additional 29% with that scenario. So 40% annual gains compounded quarterly, 5 years turns into 67,000. 10 years turns into 452,000. 15 years into 3.04 million, and 20 years compounded quarterly, right? So you get 46% instead of 40%, turns into 20.48 million after 20 years. So again, you're probably not going to be able to do that, as far as a 40% annualized return, but based on the rotation stacking, this might be what it looks like. This might be a little bit more realistic example. You pick one stock, you hold it for 3 months, you make 7%. You pick another stock, you hold it for 3 months, you actually lose 3%. You pick another one, you make 14%, and then you pick another one, you make 12%. So add it all up, at the end of 10,000 years, $10,000, it grows into $13,251. You know what that is? That is a 32.51% annualized increase. 32.5%. Guess what? Your $10,000 grows into far more than $1.9 million. It grows into $2.79 million. So if this were how this worked out, if you repeated this every year for 20 years, that's what you're looking at. 2.79 million, not 1.9 million. 15 years, you're at 682,000, right? And if you're at $100,000 and that's what you start with, that grows into 408,000 in 5 years. You're looking at a fourfold increase in 5 years based on this type of rotational stacking. 100,000 after 20 years grows into 27.9 million after 20 years. That's with a 32% scenario based on this sequence. Okay, and again, it's for illustrative purposes only, but this shows you why everyone should consider starting this now. What we're doing is we're trying to stack these profits, these annualized returns, one on another, and increase our ability to achieve these goals. And so every 5 years in this example, every 5 years you're talking about growing your money by a factor of 4. 10,000 into 40, and then 40 into 167, then 167 into 682, and then 682 into 27 or 2.79. That is a fourfold growth every 5 years, and that's how you do it. We don't want to pick one stock and put 100% of our capital in that one stock each rotation, obviously, right? So this is for illustrative purposes only. We still want to diversify. And so that's why we have a group of about 150 seller stocks that we are rotating throughout the year based on the 4 conditions that need to exist. That is this approach. Now, sometimes we hold for as short as a couple of weeks, sometimes for 6 months or longer. The average hold is just under 4 months, and then our average allocation is just under 80%. So we have not been fully allocated. In other words, if you start with a $50,000 portfolio, and this track record, by the way, is based on a $50,000 portfolio. If you start with a $50,000 portfolio, we are actually only exposed about $40,000 at any given time, on average. Okay? Now, there's one last major component to the super portfolio rotation approach, and it's one that will give you the confidence to be aggressive in your approach, and it will enable you to put yourself in a position to achieve these 25, 30, even 35% returns in a mediocre performing year, or even with mediocre performing years. And that one last major component deals with the question of what if stocks crash? Because it's really only a matter of time, right? Especially right now. It's only a matter of time when stocks crash. Now, we're in an election year. And, going into the election, it looks pretty decent. What happens after that is anybody's guess, and especially since we're just making just astronomical moves in the stock market right now. So the question is, what if stocks crash? And it has to be answered. And I'm going to show you that here in a second. I'm going to address that here in a second. But if you already know that you want to get involved with the super portfolio rotation signals, again, it doesn't take very long at all to take these signals. But if you know you want to get involved, you can go ahead and give Spring a call at 918-203-7547. You can reserve your spot. Now, here's what you're going to get. I'm actually going to reveal to you the entire 150 super portfolio stock list. I'm going to give you every single stock that's in our portfolio. And I'm going to do that kind of as a bonus, basically. Just so that you can see, and by the way, this portfolio, it's worth it all by itself. Okay, so I'm going to give you that list. I'm going to give you weekly alerts in the SPR with basically newsletter. You're going to get a newsletter every week, and it's going to contain the exact instructions for exact entry and exits for the stocks. Very simple to follow, very easy to follow. Okay, so you're going to get those. You're going to get a monthly recap of the performance. And then you're also going to get a quarterly super portfolio rotation recap webinar where we talk about what's going on in stocks in general. We talk about our positions. We talk about our trades. We close trades. We talk about our open positions. And I answer any and all questions. Okay, so let's just take a look at the group of stocks real quick. Okay, if all you had were this group of stocks, 18% annually, 19% annually, 21% annually, 19, 17, right? These are the ones that I showed you earlier. If you just had all of the stocks that are in this rotation, you're talking about just a massive amount of research that has gone into putting together this group of stocks. If you did nothing but have these stocks and you put a little bit into each stocks and just a buy and hold, you're already putting yourself at a really solid probability of outperforming the S&P 500 over the next 20 years. So that's really a solid bonus, if you will, of these stocks, because the buy and hold with this group of 150 stocks has outperformed the S&P 500 over the last 20 years by a factor of almost 10 times. That's how powerful and strong these stocks are. Now, again, that might not continue to be the case, right? It might only outperform by 5-fold or 7-fold or 8-fold or whatever. And there is a possibility that it doesn't outperform the S&P at all. But what other method are you going to use to garner a solid group of stocks other than what we have done? It's probably not going to be any better, right? So, and I make that statement based on my 35 plus years of doing this and seeing everything out there and then some. So you're going to get all 150 stocks. You're going to get a full performance analysis of each stock over the last 20 years. Again, this is worth the cost of the super portfolio rotation package alone. Then again, you're going to get the weekly newsletter. This is, for example, a current signal that we have in HELE, which I've already showed you. We've already taken 2 trades. We have another limit order in place, and if you can follow this is based on a $50,000 portfolio. Buy HELE 9 shares at $94.50 on a limit, and our target, if we're filled, is going to be 107. Simple as that, right? How long does it take you to put that order in? Not long. That's how simple this process is, and you're going to get this. And there's obviously a larger group of stocks that we are looking to enter at any given time. And the targets are in place at any given time. Right? So that's very, very straightforward. Comes with a list of all current open positions, all closed positions for that calendar year, updated performance, including dividends received, which I have not discussed here, but we do include that in the performance. And then I provide commentary in these weekly portfolios. And all of these, everything that we report is actual fills, not hypothetical. We invest in the S&P, or the super portfolio rotation signals. Okay. Then you get the quarterly recap live webinar, and again, where we discuss this and I answer any and all questions. So I'm there at least once a quarter to do that. We have special pricing here. It's $297 a quarter. If you want to go quarterly, we don't give you the stock list because, again, it's worth way more than that. Just the stock list alone is worth way more than that. But if you subscribe for either 12 months or 2 years, you're going to get the stock list. 12 months, it's $997, so it's only $83 a month. For the 2 years, you get a big discount. It comes out to only $62 a month. And with both of these, you get the stock list included. But there is a bigger bonus to that. And that is, after 2 years, the yearly subscription drops to $297 a year for life. So we want you to commit to this, because the best success is going to be based on long term, right? And so, we want you to at least come in for 12 months and give it yourself a shot at this. And for $997, we give you the list for that. Then you renew for $997, and then after that, it's $297 a year. But if you commit for 2 years, you pay only $14.97, and then every year thereafter, you're grandfathered into $297 a year. That's it. And so we are committing to you. If you commit to us for 2 years, we will commit to you for the remainder lifetime of your subscription, for as long as you want to be subscribed, for only $297. So we really want, if you want to, kick around the tires, see, kind of see what we're doing, you can do that for a quarter for $297. Okay. Now you're gaining, again, access to 30 years of experience, 35 plus years of experience, really. Analysis and work for $62 a month for this program. So again, if you subscribe now for 2 years, you'll never pay more than $297 a year thereafter. So I'm going to strongly encourage you to do so. And this is for a limited time, all right? Very limited time. All right, one last major component to the super portfolio rotation. What if stocks crash? What if stocks crash? Well, first I want to show you something. The red line is SPY from 1997 to 2012. And I want you to notice that during that time period, really not much of a return. Not much of a return. If you go from here, 1997 to about 2009, which is after the market crashed, you've got no return for almost 10 years, actually more than 10 years. A net return of zero, the big goose egg, because of two crashes. But if you can avoid the crash, and just kind of remain steady, maybe down a little bit, maybe up a little bit, but overall kind of remain steady. And then once stocks resume, you resume that from a much higher point, right? And here's you avoid the crash, right? Avoid the crash, and then once they start resuming, you resume as well. If you can do that, you're talking about an astronomical increase in your overall annualized return. It goes from 8.6% annualized return to 18%, and that's the buy and hold. Okay, so you can literally buy and hold with what I'm about to show you, and that alone will increase significantly. You would be up 100 or 270% after this time period instead of the 130% with a normal buy and hold. And that's based on knowing how to hedge. So with the super portfolio rotation, what we're doing is we're investing 1.5% of our account into any given signal. Okay, 1.5%. And you can alter that a little bit, but that's what we generally do. And with that, you can have approximately 67 open positions at any given time out of the 150 stocks. Now, we are not in 67 positions most of the time. We are in that in something less than this most of the time. So we're never fully exposed in the first place. And so it's important for you to understand that way. So we have about $40,000 average invested in a $50,000 account in the S&P or in the super portfolio rotation. So we're only about 80% invested on average. Now, we will get close to being fully invested from time to time, but that's going to be about average. And if stocks utterly crash and we don't have any hedge in place, we will have a bit of a buffer, right? Because we aren't fully invested. But on the flip side, we also have a lower probability of realizing a larger gain if stocks do well, because if stocks do well and we're only 80% invested, then we're going to do well with only 80% of what we have, right? So there is that flip side of it. And so the question is, how do you manage that, or can you increase your overall allocation and be willing to take a little bit more of a risk in that scenario? And to answer that question, I'm going to again remind you, every percentage point counts. Okay, every percentage point counts. So if I can show you how to be fully invested while never risking a market crash again, you will have a greater chance of increasing your overall average annual return substantially. So again, starting with a $100,000 account, interest compounded annually, there's a $3.2 million difference between a 10% return and a 20% return. And a lot of this has to do with having to endure the time periods where the market crashes. So check this out. $1,000 invested in the S&P in 1995, suffering through market crashes, and you're looking at about that $1,000 turning into $10,000. But if you can avoid the market crashes, you're looking at that same $1,000 turning into $30,000. Right? So a major difference in the overall net return. So what I'm going to do is, as an added bonus, I'm going to be providing free access to a video that I've entitled How to Hedge Any Stock Portfolio. How to Hedge Any Stock Portfolio. And when you implement one of my powerful, simple hedging strategies, not only can you avoid significant losses during a market crash, you could actually make money. Okay, so if the market crashes 35%, if you can remain at 5% drop in equity or better, you are going to do really well. And here's how it works. Okay, you put on a particular hedge strategy. And in this case, this is a SPY. The market's trading about 435-ish here, right? So that's about 435. And let's say the market crashes and it goes all the way down to about 321. Well, your hedge is not going to make a lot of money on this initial move down. But as the market continues to crash, you're looking at eventually making $18,000 on this particular hedge. So the market was trading just above 432. That's a total value of $43,000. Okay. And if it crashes down to about 321, you're looking at a little more than a 25% drop. And so you're looking at about $12,000 to maybe $13,000 here. If the market crashes to 320, that's an $11,200 drop in one contract of SPY because it was worth $43,200. And now it's only worth $32,000. But your hedge made $18,000 in this example. So you lose 11.2 in the crash, your hedge makes 18,000, and you have a net gain. Now, it's not going to happen that way all the time, and there are different things that you're going to be wanting to do that's probably going to drop this a little bit as the market moves down, because what you're going to be doing is you don't want to put on a trade and watch it go up to a value of $18,000, and you continue to hold on to it, and then it comes right back down, right? What you want to do is you want to reposition the hedge, and that's what this video is all about, and that's going to preserve a good large chunk of that $18,000. So if the market turns around and moves up, you now, let's say, pocket $13,000, and the market moves back up, so all of your stock positions are moving back up as well, and so you regain the $11,000 loss. So you would be back to normal if all you had was the buy and hold, but if the market recovers, you're back to normal plus $13,000 is how that works. Very, very powerful. This is a one-of-a-kind video, and I'm going to show you how to create low-cost, high-reward hedge positions that will safeguard you from a significant drop in stocks and or the super portfolio rotation. This video will also show you how to reap the rewards on the way down and open up your portfolio to regain on the way back up, which is what I just explained to you. This is such a powerful concept. You're almost going to wish stocks would crash from time to time with this hedge. And it doesn't have to just be with the super portfolio rotation. This video is worth the cost of the program if you have any significant amount in the stock world. So you're going to want access to this video. It is absolutely gold. And I update it. I try to update it about every 6 months. And it's yours as a bonus, absolutely free, as a subscriber to the Super Portfolio Rotation subscription. So when you understand how to properly hedge your stock portfolio, you can be fully invested, right? You can take advantage of being fully invested because you're fully hedged, or a majority of the down move is going to be hedged, right? Either way, you're going to be better off in that scenario during a crash, knowing that the majority of your downside is protected, giving you maximum efficiency to compound. It's all about the compounding. Everything we do is to create a more efficient compounding. Why? Because every percentage point matters in compounding. So if you never want to lose sleep over your investments again, you want to maximize your potential compounded growth, you want to potentially make money even if stocks crash, you want to participate in the recovery, you want to invest with confidence, you want to be maximally invested even if you think stocks are going to crash, and you want to create a substantially better consistency in your overall trading, this is going to be gold for you. Again, if we enter into this, and it would not surprise me if we enter into this type of scenario, where we get into a 13-year drought before new market highs are made, you're going to wish you invested in this program. At some point, it's going to happen, right? At some point, the crash is going to happen. And SPR, absolutely, during a market crash, it absolutely will lose money, right? Our stocks, as good as they are not immune from a market crash. If the market crashes, it's going to take a majority of our stocks with it, hopefully by not as much. So it really doesn't matter what you're in, whether it's S&P, whether it's SPR or another portfolio. You need to hedge if you are going to be efficient with how you invest. Okay, so how to hedge your super portfolio rotation account. Absolutely necessary. It's one of a kind video. You're going to want it no matter what. None of the individual stock performance examples were based on hedging, by the way, during the 3 separate crashes since 2000. So when I gave you the performances of each stock, 10,000 turning into X, that did not include any timing, and it did not include any hedging. And so you can imagine what the timing plus the hedging can do for the performance of this approach. After a crash, stocks generally move up faster, recovering from the crash usually within 3 to 5 years, right? And that actually gives you a significant opportunity in that scenario, because as the market goes down and your hedge is adding, guess what you can do? You can add more to your stocks, right? You can cost average. So in this example, just kind of give you an example here. Stocks crash 35% of the time. The SPR hedged losses or loses 7%. Then stocks regain 35% over 3 years. Well, the SPR will also gain 35% over the next 3 years, but it will have not started from being down 35%. So in this example, SPR is up 28% while stocks are at a break-even. All right, so that's the reality of how powerful this is. So remember, every percentage point counts. Maybe you start a college fund for your kids or your grandkids, or you just allocate $20,000 or $30,000 into the SPR for retirement. Whatever the case is, maybe you have $1 million in market exposure, and that would make this hedging video worth every penny of it alone. And especially in today's economic climate where unexpected world events can wipe out investments. I mean, there's so much talk of World War III right now. Back when North Korea was making a little more active threats, you would see volatility in the stock market. That's coming back. So this is very, very important. And $20,000. A $20,000 allocation in the SPR with 25% annual returns, especially if you hedge, grows to $1.7 million. 100,000 conventional, 7% annual return. If you don't do SPR and you don't achieve these kind of returns, if all you do is 100% conventional, 7% annual return only turns into $386,000 after 20 years. Here's what I want you to see. Okay, you might be on the fence. Maybe I'll get into SPR, maybe I won't. Well, you can take $20,000, and if SPR works, and you're hedged, and giving you an even better probability of that happening, you're looking at that $20,000 growing into 1.7 million. Right now, if you have $100,000 and you're like, I don't want to put all $100,000 because I have my own investment, approach that's proven. I've been making 7%, whatever. So I don't want to, I don't want to switch it at this point, and that's fine. So you take $20,000 and you put it into SPR. Well, guess what? If SPR works, it's going to outperform your $100,000 investment by a factor of 4. So this $20,000 will outperform your $100,000 conventional by a factor of 4, almost 5 actually. It's 1/5 of the investment risk in SPR potentially grows almost 5 times bigger than the conventional investment that starts with 5 times more capital. So here's another idea. You have $100,000 invested in the stocks right now. You're concerned about a crash. You can pull out $80,000, put it in cash, put it in something safe, put it in, whatever the case is. Take $20,000, put it in SPR, hedge that $20,000, and if it works, you're looking at a growth that is 5 times bigger than what you would have had with that $100,000 at 1/5 of the risk exposure. Okay? If that doesn't convince you that this is something that you need to seriously look into, even if it's only for a quarter, and you invest, $249 for the quarter, you cannot afford to not allocate something to SPR, and especially when you combine it with the hedging video. All right, so that's it. That's what I'm gonna end it with that. You probably have a pretty good understanding whether you want to get involved or not. Trial basis at $297, or if you want to commit, get the entire group of stocks, learn how we rotate this on a long-term basis. It's just a tremendous product. Limited time. This is limited time pricing, so call Spring at 918-203-7547 or click the link below this and grab your copy now. And remember, if you subscribe for 2 years, you're looking at only $297 a year thereafter. And you're going to continue to get the update videos on the hedging. You're going to continue to get the webinars, access to the webinars, the weekly reports, all of that for only $297. And you'll also continue to get the updated stock list. So as we make alterations in the stock list, you're going to get those updates on a yearly basis as well. All right, so take the time, call Spring now, reserve your spot, and I will see you on the next webinar.